Did you know your pension contributions might be limited without you realizing it? The tapered annual allowance could be silently affecting your financial future. Let's uncover its hidden impact together. The tapered annual allowance for the 2025-2026 tax year is £60,000. If you have enough income, you can contribute up to this amount, either personally or through your employer, without facing extra tax charges. However, since April 2023, if your adjusted income, including employer pension contributions, is over £260,000, your annual allowance may be reduced. This will be for every £2 over the limit. £1 is taken off your allowance, provided your threshold income is also above £200,000. The annual allowance can be reduced by up to £50,000, meaning high earners may have as little as £10,000. Tapering stops at £360,000 of adjusted income. If contributions exceed the reduced limit, a tax charge may apply. The final allowance is rounded down to the nearest pound. Individuals caught by the tapered annual allowance restriction may face practical challenges in managing their pension contributions. As the reduction in annual allowance is dependent on income levels, those with earnings in the upper level may need to carefully assess and adjust their pension contributions to comply with the annual allowance. Understanding adjusted and threshold income is key to knowing if you're affected by the tapered annual allowance. Adjusted income includes all sources of income plus pension contributions, while threshold income excludes pension contributions. These calculations help determine how much you can contribute to your pension without facing a tax charge. To calculate threshold and adjusted income, we start with your total taxable income. For threshold income, we deduct gross personal pension contributions, then add back any salary sacrifice arrangements made after July 2015. Finally, we deduct any tax lump sum death benefits received. For adjusted income, we take taxable income and add employer pension contributions and any pension tax relief claimed before it was applied. We then deduct any tax lump sum death benefits. These calculations are essential to determine if the tapered annual allowance applies. If you're affected by the tapered annual allowance, it's important to manage your pension contributions carefully. You may need to reduce personal or employer contributions to stay within your limit. If contributions exceed your allowance and you can't use carry forward from previous years, you could face an annual allowance tax charge. If you go over your annual pension allowance, the first step is to check if unused allowances from previous years can cover the excess. If not, the surplus is added to your income and taxed at your highest rate. This is usually paid through self-assessment, but in some cases, you can ask your pension provider to pay it directly using scheme pays, though it must still be reported on your tax return. Everyone's needs are different, so speak to a qualified advisor before making any decisions. Always check your policy's terms and conditions, and remember, tax rules can change and may affect any benefits you receive. Understanding pension tapering rules can be complex, so it's important to stay informed and seek professional advice. A financial advisor can help you make the right decisions and avoid unexpected tax implications.